Imagine a nearly 100-year-old company, founded way back in 1925, deeply rooted in family legacy.
Yeah, where the history is, practically built right into the walls of the headquarters.
Right, exactly. Now imagine that same historic institution suddenly being forced to navigate the absolute most expensive, catastrophic weather disasters in its entire century-long existence.
Which is incredibly daunting. I mean, billion-dollar storms.
Yeah. And just to, amplify the pressure, while they are battling these unprecedented storms, they're simultaneously trying to rip out their legacy plumbing and integrate cutting-edge, enterprise-level artificial intelligence directly into their core operations.
It's a lot all at once.
It is a massive, high-stakes collision of the past, the present, and the future. And it's all happening at exactly the same time.
Which really makes it the ultimate corporate stress test, honestly. You've got this foundational legacy meeting modern volatility head on.
Exactly. And, for our listener joining us today, welcome to the deep dive, because today we're looking at the Q1 2026 earnings call of Erie Indemnity to find out exactly how a century-old bloodline handles a modern financial hurricane.
Right. And, earnings calls from legacy financial institutions are usually treated like, like sleeping pills by the general public.
Oh, totally. Just incredibly dry.
Yeah, they're dense, they're heavily coded in corporate jargon, but if you actually know how to decode the language, there are these really dramatic narratives about survival and strategy.
Which is exactly our mission for this deep dive, because we have the sole source material for today, which is the actual transcript featuring CEO Tim Nekastro and CFO Julie Pokowski.
And there is so much to unpack there.
There really is. We are going to look past all that sterile financial jargon. We want to uncover this fascinating story about engineering a massive financial turnaround.
And balancing that really painful trade-off between growing your customer base and, actually making a profit.
Right. While also trying to figure out how to modernize this massive workforce without losing the essential human touch that, frankly, kept them alive for the first 100 years.
So as a brief roadmap for you listening, we're going to first look at Erie's unique corporate structure and some historic leadership shifts. Then we'll unpack their massive financial recovery from a really disastrous 2025.
Which was a rough year.
Oh, incredibly rough. Then we'll get into the painful trade-offs of that recovery. And finally, look at the AI revolution happening inside their walls right now.
Perfect. So let's jump right in. Because before we can even talk about how Erie made its money in the first quarter of 2026, we have to explain how they make money fundamentally.
Right. The actual structural blueprint.
Yeah. And honestly, right at the top of this transcript, looking at the corporate structure, it gets kind of weird.
It does. It's not your standard corporation.
Right. They describe Erie Indemnity, which is the publicly traded entity we're actually looking at today, as a, quote, managing attorney in fact for the subscribers at the Erie Insurance Exchange.
Which is a mouthful.
It really is. I mean, I had to stare at that phrase for a minute, but I think I've got a decent analogy to translate this into plain English.
Okay, let's hear it.
Is it essentially like a massive property management company? Like, say you have a gigantic apartment building.
Okay.
And the property management company handles all the administrative nightmares.
Right.
They fix the plumbing, they collect the rent, handle the advertising, pay the leasing agents, but they don't actually own the building.
Right.
They just manage the chaos for the owners and take a predetermined cut of the rent for their services. Is that basically the right way to visualize this attorney-in-fact relationship?
That is precisely the right way to visualize it, yes. And taking that property management analogy a step further, just like a property manager takes their cut of the rent, regardless of whether, say, the apartment building's roof caves in.
Oh, interesting.
Right. Erie Indemnity is structurally insulated from the actual insurance risk.
Okay, so the indemnity company isn't paying out the claims.
Exactly. Erie Indemnity, the company issuing this earnings report, they manage the day-to-day operations for the Erie Insurance Exchange.
So what is the exchange then?
The exchange itself is the actual pool of insurance policies. It's a mutual entity, which means it's literally owned by the policyholders.
Got it.
But an abstract pool of policies can't, hire IT staff.
Right, a pool of money can't pay the electric bill.
Exactly, it can't process claims. So Erie Indemnity steps in to be the operational brain. They handle policy issuance, they process the renewals, run the underwriting algorithms.
And to maintain the servers, manage the agents, all of that.
Exactly, and in exchange for doing all of that heavy lifting, Erie Indemnity earns management fees directly from the exchange.
It is a brilliantly structured business model. I mean, you get all the cash flow of running a massive insurance operation without actually holding the bag if a hurricane wipes out a coastal city.
Precisely. The exchange pays out the hurricane claims. Indemnity just keeps collecting its management fee for processing the paperwork.
Wow. Okay, so it's a totally symbiotic relationship.
Yeah.
But they are legally and financially completely distinct entities.
Right. And the people steering that management entity are going through a really monumental changing of the guard right now.
Yeah, let's talk about that because the transcript details some massive shifts on their board of directors in early 2026. And the historical roots here are just incredible.
They really are. You've got Tom Hagen stepping down as chairman after holding that seat for more than 2 decades.
20 years in one seat.
Right. And he's taking on the title of chairman emeritus. But the really wild part is his replacement. Unanimously elected by the board is Jonathan Hurthagen.
Who is Tom Hagen's son?
Yes, but far more importantly, he is the grandson of the company's original co-founder, H.O. Hurt.
Let me just pause on that for a second.
Hey.
A founder from 1925 effectively still has his direct bloodline taking the gavel in 2026.
Yeah.
That is wild.
It's incredibly rare in the modern economy. I mean, when you look at the landscape of publicly traded financial institutions today, executive turnover is just incredibly rapid.
Yeah, often ruthlessly so.
Exactly. The average tenure of a CEO or a board chair at a major corporation right now is frequently just like 3 to 5 years.
Right. Boards are constantly shuffling people around to appease activist investors looking for some short-term stock bump.
So think about what it signals to the market when a founder's grandson is unanimously elected to chair the board.
It has to signal just a massive level of stability.
Absolutely. And it's important to note, Jonathan Hurthagen isn't some inexperienced heir just being parachuted in. He has been deeply embedded in the governance of the company for decades.
Right. He's been on the board since 2005, I saw.
Yes, and vice chair since 2013. Elevating him broadcasts to institutional investors that there is a serious multi-generational perspective at play here.
It's not a private equity firm stepping in to, gut the operational expenses for a quick flip.
Exactly. It's the deliberate continuation of a bloodline that views the company's century-long reputation as its absolute most valuable asset.
It really feels more like a multi-generational community trust than a standard cutthroat corporate boardroom.
It does.
And you can see that really deliberate curation of culture in the other board announcements they made too. Like they brought on a new face, William Edwards.
Right, an employment lawyer.
Which makes total sense, right?
Yeah.
Because you absolutely need sharp employment legal counsel on your board when you're navigating hybrid workforces and AI integration in 2026.
Oh, the legal landscape of employment right now is an absolute minefield.
For sure. But even Edwards has this deeply embedded historical tie-in. He happens to be the board chair at Wittenberg University.
And why does that matter?
Because that is the exact alma mater of the co-founder, H.O. Hurt.
Wow.
They literally went back to the founder's intellectual roots to find their newest legal mind.
It is a textbook example of cultural alignment. You bring in vital, contemporary external expertise, but you're actively sourcing it from a wellspring that culturally understands the DNA of the founders.
Well, even the outsiders aren't truly outsiders.
Exactly. And that fierce, almost familial loyalty was palpable later in the call, too.
Oh, when they announced the passing of George Lukeur.
Yes. He was a retired executive vice president of field operations who'd been on the board since 2016. But his story goes way deeper than just a standard board seat.
Yeah, the CEO actually paused the financial updates to genuinely honor his decades of service.
Which you don't always see on these calls.
No, usually it's just straight to the numbers. But he pointed out that Lukeur spent 30 years as an employee. He worked his way through the ranks, retired in 2010, and then immediately continued serving as a board member.
30 years. It really paints a vivid picture. Erie is a modern financial institution managing billions of dollars, but culturally, it operates with the loyalty of a small, regional family business.
But I guess you don't curate a board like that just for nostalgia?
No, absolutely not. You build that kind of architectural stability because when a crisis hits, a fragmented, short-term board is going to panic.
Right, they start pointing fingers, making rash decisions.
Exactly. But a unified, historically grounded board holds the wheel steady and steers through the chaos, and that stability was absolutely vital.
Because in 2025, Erie sailed straight into a historic crisis.
A crisis is almost putting it lightly. The weather in 2025 was an absolute buzzsaw for the insurance industry.
And Erie took it right on the chin.
They did. And CEO Tim Nekastro didn't try to sugarcoat it on the call at all. He explicitly admitted that 2025 was one of the most challenging periods in the company's entire 100-year history.
He specifically highlighted an unprecedentedly expensive weather event from March of 2025.
Right, which became the single costliest weather disaster they had ever faced.
So going into Q1 2026, the entire market is watching them. Everyone is waiting to see if this century-old ship is basically taking on water faster than it can bail it out.
Exactly. And to understand the magnitude of their recovery, we have to break down the central metric of the entire insurance industry.
The combined ratio.
Yes, the combined ratio is the absolute pulse of an insurance company's core operations. Let's unpack exactly how this metric works for the listener because it tells the entire story of Erie's turnaround.
Please do, because it sounds complicated, but I know it's actually just a math equation.
It is a really simple fraction. The top half, the numerator, is the sum of all incurred losses.
Meaning the actual money paid out to customers to, fix their roofs or replace their cars.
Exactly. Plus the operating expenses of running the business. Paying the adjusters, keeping the lights on, maintaining the software. So that's the top number.
The money going out the door.
Right. And the bottom half, the denominator, is the earned premium. The actual cash collected from customers for their policies.
So it's basically money going out divided by money coming in.
You got it. And the magic threshold is 100%.
Okay, why 100?
If your combined ratio is exactly 100%, you are perfectly breaking even on your underwriting. You collected exactly as much as you spent.
Okay.
If it creeps over 100%, your core operations are actively bleeding money. You're paying out more than you're collecting.
Gotcha.
But if you can push it under 100%, you are turning a pure underwriting profit.
Okay, keeping that 100% threshold in mind, let's look at the actual numbers CFO Julie Pokowski dropped on the call.
This is where it gets dramatic.
It really does,
Yeah.
because in Q1 2025, during those massive historic weather disasters, Erie's combined ratio was a disastrous 108.1%.
Which is brutal.
Yeah, for every $100 they brought in, they were paying out $108. That is a heavy, heavy bleed.
A massive leak.
But fast forward to Q1 2026, and the CFO reported that the combined ratio dropped all the way down to 99.4%.
An incredible recovery.
Now, wait a second. Let me look at this math here. Because 99.4% means they collected $100 and paid out $99.40.
Correct.
They're making exactly 60 cents on $100.
Yes.
You cannot run a century-old massive corporate enterprise on a 0.6% profit margin. The CEO on this call is framing this 99.4% as a monumental victory. But to me, they are barely scraping by a fraction of a percent above a dead-even break.
Which sounds completely illogical, right?
Yeah. There has to be a missing piece of the puzzle. Are they, taking those upfront premium payments? Because I know I pay my car insurance 6 months in advance and quietly investing that pile of fash in the market before the claims actually hit.
You just deduced the exact financial engine that powers the entire global insurance industry.
Really? So it is about the investments.
Absolutely. You are entirely right. A 0.6% underwriting margin sounds terrible if you're selling software or, manufacturing cars.
Right. You'd go bankrupt.
But insurance companies do not exist solely to make money on underwriting. Their real profit engine, the true mechanism of wealth generation, is something called the float.
The float. Okay, walk us through the mechanics of the float.
When you write a check to Erie for a year of homeowners insurance, you hand over that money today.
Right.
But your house might not get hit by a tree for 3 years. It might never get hit by a tree.
Hopefully never.
Right. But in the meantime, the insurance company gets to hold on to your cash. When you multiply your premium by millions of other customers, you get this staggering pool of billions of dollars.
And that massive reservoir of unpaid out cash is the float.
Exactly. And what does Erie do with that float? They don't just put it in a checking account, they invest it.
Right.
They pump it into municipal bonds, treasury yields, high-grade corporate securities, and the return on those billions of dollars is immense.
Okay, so when an insurance company hits a combined ratio of 99.4%, it actually is a spectacular victory.
Because it means the core insurance operation is entirely self-sustaining. The premiums are fully covering the claims and the electric bills, which means the company does not have to liquidate or dip into the float to cover its losses.
Oh, wow. They get to keep, compound, and distribute 100% of that massive investment income.
Exactly. Dropping the combined ratio from 108.1% down to 99.4% isn't just quote-unquote breaking even, it is sealing the leak in the hull so the investment engine can run at full throttle.
That completely changes the paradigm. The insurance operation is essentially just a giant break-even mechanism that exists solely to generate and protect this massive pool of free investable cash.
Yes. If the underwriting simply pays for itself, the investment side is pure, unadulterated upside.
Incredible. So how exactly did Erie pull off this massive, nearly 9-point drop in a single year? I mean, it couldn't have just been that the clouds parted and the weather got nicer, right?
Well, it was actually a combination of the weather reverting to historical norms and aggressive operational strategy. The CFO broke the improvement down into two distinct buckets.
Okay, what's the first bucket?
About 7 points of that roughly 9-point improvement came directly from lower catastrophe losses.
So the weather actually did just get nicer.
Simply put, yes, the weather in Q1 2026 wasn't apocalyptic. They didn't have a freak, historically destructive superstorm tearing through their footprint like they did in March 2025.
Okay, so the environment gave their balance sheet a massive break.
It did. But 7 points from better weather only gets you from 108.1 down to roughly 101.
Right, and you're still losing money at 101.
Exactly. So where did the rest of the improvement come from to push them under the 100% threshold?
The second bucket.
Yes. The remaining improvement came from a reduction in non-catastrophe losses. And this is the real operational win. Because this wasn't luck with the weather radar. This was driven by what the CFO very politely referred to as, quote, stronger rate adequacy.
Stronger rate adequacy. That is a beautifully sterile piece of corporate vocabulary.
It really is.
If you don't mind, I'm going to translate rate adequacy into plain English for the listener.
Go for it.
They jacked up the prices.
Yes, they did.
They looked at the massive losses from 2025. They looked at the rising costs of inflation. The skyrocketing prices of lumber to fix homes and microchips to fix bumpers. And they realized they were vastly undercharging for the risk they were taking on.
Right.
So they hiked the premiums across the board.
Precisely. To fix the combined ratio, you either have to magically stop people from getting into car crashes, or you have to increase the denominator of that equation, the earned premium.
And since they don't have a magic wand, they chose the mathematical certainty of raising rates.
They did. But, in any complex business ecosystem, every drastic action has an equal and opposite reaction.
Oh, for sure.
Fixing your profitability problem by systematically raising your prices immediately introduces a brand new, equally dangerous problem. You ignite a brutal tug of war with your own growth.
Because customers aren't just rows on a spreadsheet who blindly accept a price hike.
Exactly.
And the transcript shows a stark, undeniable contrast that illustrates this exact tug of war. Let's look at the growth of their direct written premium, the total amount of new policy money coming in the door.
Okay, let's look at the numbers.
In Q1 2025, despite the terrible weather, they were growing their premium base at a very fast, very healthy clip of 13.9%.
That's strong growth.
Really strong. Fast forward to Q1 2026, after they've implemented this quote-unquote rate adequacy, and that growth rate absolutely plummeted to just 3.6%.
It's a huge drop. And if we peel back the layers on that 3.6% growth figure, the mechanics of this tug of war become glaringly obvious.
What did the CFO say?
Well, she noted that the average premium per policy actually grew by 8.1%.
Okay, so that is the rate adequacy in action. Every single policy they hold is generating, on average, 8.1% more revenue than it did a year ago.
Correct. But simultaneously, the actual number of policies in force dropped by 1.7%.
Wow. So they are squeezing significantly more money out of each individual customer, but they have physically fewer customers overall.
Exactly.
I mean, it's pure psychology for you as the listener.
Yeah.
If you open your mail on a Tuesday afternoon and see that your auto insurance bill has suddenly jumped by 8% for the exact same coverage you had last year, you don't just smile and write the check.
No, you absolutely do not.
That 8% hike shatters your inertia. It prompts you to open your laptop, go to a competitor's website, and see if they can beat the new price.
And the numbers reflect exactly this shift in consumer behavior. Erie's retention rate dropped to 88%.
Which, I mean, in a lot of industries, keeping 88% of your customers sounds fantastic. If you get an 88 on a college exam, you're thrilled.
Sure.
But in a recurring revenue business model like insurance, losing 12% of your entire customer base in a single 12-month window is a catastrophic leak in the hull.
It's the ultimate leaky bucket problem.
Yeah. If 12% of your water is draining out of the bottom of the bucket every single year, your marketing and sales teams have to pour 12% more water into the top of the bucket just to keep the water level exactly where it was yesterday.
And it creates an exhausting, expensive treadmill effect. Because the cost of customer acquisition in insurance is incredibly high. You're paying for massive ad campaigns, you're paying agent commissions, underwriting reports.
Right.
If you have to replace 12% of your book of business every year just to stay flat, your growth engine stalls out.
And the CEO was surprisingly candid about this, right?
He was. He openly acknowledged that they're operating in a, quote, more competitive landscape. Erie successfully stopped the bleeding. They restored their profitability by hitting that 99.4% combined ratio.
But the cost of that survival was making their products noticeably more expensive.
Which makes it exponentially harder for their agents to win new business, especially if they're pitching against a competitor who hasn't raised rates yet or who's deliberately underpricing their own risk just to aggressively grab market share.
So we've seen how the underlying insurance exchange is dealing with this dilemma. They fixed the profit, but they choked the growth. Now, let's pivot.
Okay.
I want to see how this exact dynamic translates to the management company's ledger. Because remember, back to our property management analogy, Erie Indemnity, the company issuing the stock, doesn't take the weather risk.
Right. They just take a management fee based on the size of the operation.
Exactly. So if the exchange is shrinking its customer base by 1.7%, how does that impact the property manager's bottom line?
The answer, surprisingly, is that the property manager had a fantastic quarter.
The numbers are great. Indemnity's net income hit $151 million, or $2.88 per share.
Which is a very solid jump from the $138 million they posted in the disaster quarter of Q1 2025.
Yeah, their operating income jumped 10% to nearly $167 million. And the management fee revenue, the actual cash they collect for running the exchange, grew 4.2% to $31 million.
And that 4.2% growth in management fees is a perfect reflection of the structure we discussed earlier.
How so?
The fees are largely based on the total premium dollars, not the raw number of human beings insured. Because the average premium went up 8.1%, the total pie of premium dollars grew.
Even though there were fewer people paying into it.
Exactly. As the premium pool gets bigger, Indemnity's management cut gets bigger. They are insulated from the loss of policyholders as long as the remaining policyholders are paying significantly more.
That is just brilliant structuring. But as I was combing through the expense side of Indemnity's ledger, I spotted a massive paradox. Something that, on its face, completely defies basic math.
Oh, the commission expenses.
Yes. CFO Julie Pokowski noted that commission expenses, which are the single largest operational cost for Indemnity, the money they pay to the agent selling the policies went up 6.4% to a staggering $465 million.
Right.
How on earth does your commission expense go up by 6.4% when the actual number of policies your agent sold went down by 1.7%? If your sales force is moving fewer units, shouldn't their commission checks be shrinking?
It is a brilliant catch, and unpacking that paradox reveals a highly sophisticated structural mechanic in how Erie incentivizes its sales force.
Okay, break it down for me.
The answer is twofold, and it shows how deeply intertwined the management company and the agents really are.
Right.
First, base commissions in insurance aren't flat fees per policy. They're calculated as a percentage of the premium sold.
Oh, I see. So even though the agent sold fewer individual policies, the policies they did sell or renew were priced 8.1% higher.
Precisely. A fixed percentage of a significantly larger pie mathematically yields a larger base commission.
Okay, that makes sense. But what's the second part?
The second part is where the real strategy lies. A significant chunk of that $465 million wasn't just base commission, it was agent incentive compensation.
Incentive compensation, like a bonus.
Yes, and that incentive compensation increased specifically because the underwriting profitability, that 99.4% combined ratio, improved so drastically.
Okay, let me make sure I'm connecting these dots correctly. The underwriters in the back office are the ones doing the complex math to set the prices. Why do the frontline sales agents get a massive financial bonus when the back office underwriting turns a profit? Do they get paid a bonus if the people they sell to don't crash their cars?
In a roundabout way, yes, that is exactly how it works.
Are you serious?
Completely. And to understand why, you have to understand the independent agent model. Erie doesn't employ captive agents.
Captive agents meaning like people who work directly for Erie and only sell Erie products.
Right, like at State Farm or Geico. Erie uses independent agents who run their own small businesses. They can choose to place a customer with Erie or Progressive or Travelers. Erie relies heavily on these independent agents to be their first line of defense in underwriting. They essentially create a financial feedback loop to reward these agents for bringing in, quote-unquote, good risk.
A good risk meaning a customer who pays their bills on time, maintains their property, drives safely, fundamentally, someone who doesn't file massive, frequent claims.
Exactly. If an agent consistently places high-quality, low-risk customers with Erie, the overall profitability of the exchange improves. So in Q1 2026, because there were fewer catastrophic losses and the underwriting was significantly healthier, it triggered pre-negotiated profit-sharing bonuses for the agents.
That is a masterclass in aligning incentives. You weren't just handing your agents a quota and screaming, sell, sell, sell at any cost.
No, because if an agent just churns through terrible drivers to hit a quota, the company bleeds money on claims.
And the agent loses their bonus. You are structurally telling them, sell to careful, responsible people, and if those people don't burn their kitchens down, we will actively cut you in on the savings. It turns every single independent agent into a frontline risk manager.
It really does. It's a very smart way to manage growth.
And the agents weren't the only ones who got cut in on the recovery. The shareholders saw the ultimate tangible reward too.
Yes, the dividends.
We talked about the magic of the float earlier. Well, the capital management strategies around that float paid off beautifully. Investment income increased from $20 million to $22 million, driven by higher yields in the market and larger overall cash balances.
Right.
And as the ultimate proof of their recovery, Erie Indemnity paid out $68 million in cold, hard cash dividends to their shareholders in the first quarter alone.
It perfectly encapsulates the narrative CEO Tim Nekastro was trying to project. Quote, steady, measured progress. The ship isn't just patched. It's highly profitable, it's exceptionally well capitalized, and it's actively distributing excess cash back to its investors.
And there's a big but here, they still have that massive leaky bucket problem.
Yes, they do.
The policies in force are actively shrinking. They successfully price themselves out of the bargain bin to save their combined ratio, which means they can no longer compete on being the cheapest option.
No, they cannot.
So how do you solve a growth problem when you refuse to lower your prices and you refuse to take on bad, risky drivers just to pad your numbers?
Well, if you can no longer compete by being the absolute cheapest option on the market, you have to pivot your competitive advantage.
Okay, to what?
You have to compete by being the easiest, the fastest, and the most precise option available. You solve the growth problem by radically overhauling the products and the digital platforms your agents use to close the deal. You have to remove every single ounce of friction from the buying process.
Yes. If the price is higher, the experience has to be flawless. And the transcript lays out an incredibly aggressive rollout of new, streamlined products to do exactly that.
Let's look at the personal insurance side first.
Okay. They are pushing a product called Erie Secure Auto. They piloted it successfully in Ohio. They recently expanded it into Virginia and West Virginia. And they are dropping it into 4 more states this quarter.
And what's the early feedback?
The CEO noted that in the markets where it's live, it is already driving positive submission numbers and premium growth.
Which is exactly what you want to see.
Right. Then on the commercial side, insuring businesses and fleets, they have a platform called Business Auto 2.0. They rolled this out to 8 states in 2025. And in Q1 2026, they rapidly expanded to North Carolina, Virginia, Maryland, and Washington, D.C.
And they only have one single state left, New York, to complete the rollout across their entire geographic footprint.
Which is huge.
It is huge. The emphasis on standardizing to a 2.0 platform across almost all states is a massive, often underappreciated operational leap.
Why is that so hard?
Because people outside the industry don't realize that insurance in the United States is not regulated by the federal government. It is regulated individually by all 50 states.
Oh, man. So every state has its own quirky rules.
Exactly. That means a century-old company like Erie often has decades of accumulated legacy systems. Different software, different underwriting algorithms, entirely different administrative processes for every single state they operate in.
That sounds like an administrative and IT nightmare.
It is. If you want to change a simple pricing rule, you have to hard code it into a dozen different archaic systems.
Wow.
By aggressively standardizing on a single unified business auto 2.0 platform across their entire footprint, Erie achieves massive economies of scale and underwriting consistency.
The data is cleaner.
Yes, the processing time drops dramatically, and complex pricing algorithms can be updated and applied universally with a fraction of the IT labor.
And speed is the absolute name of the game here, which brings us to the most critical update in this segment.
The new online quote platform.
Exactly. They dropped it in Ohio in February, and they're pushing it live in Maryland, Pennsylvania, Virginia, and West Virginia next month. It is designed to actively replace their older, slower, legacy quoting tools.
Which, again, goes right back to removing friction.
Totally. Think about it like this. We have all had the experience of trying to buy something on a clunky e-commerce website. You put the item in your cart, but then the site asks you to create an account.
And verify your email.
Right. And input your shipping address 3 different times and navigate a multi-page checkout process. What do? You abandon the cart and go buy it on Amazon with 1 click.
Exactly.
Insurance is exactly the same psychological game. Every single second, a prospective customer or an independent agent sitting across the desk from a customer waits for a quote screen to load is a second they might click over to progressive.com or geico.com. Friction kills growth.
It directly attacks the vulnerability we discussed earlier. The CEO explicitly stated that this new quoting platform is precision engineered to move prospects through the funnel more efficiently, improving lead conversion and drastically reducing the connection time to independent agents.
Because if your prices are mathematically 8% higher than they were last year, the customer experience of getting that quote, the speed, the interface, the seamlessness needs to be utterly flawless to justify the premium.
Absolutely.
But delivering a flawless, lightning-fast quote on the front end of the screen the customer actually sees requires a monumental amount of invisible heavy lifting on the back end.
Yes, it does.
The CEO made a point to highlight that over half of Erie's total internal systems have now been migrated to contemporary IT platforms.
And that is the grueling, deeply unglamorous plumbing required to launch sleek new tools.
Yeah, nobody wants to talk about migrating servers.
No, but you simply cannot build a modern millisecond response quoting engine and wire it into a 1980s mainframe. It just doesn't work.
Right.
Migrating more than 50% of their core systems to contemporary cloud platforms is the foundational infrastructure that makes the innovation possible. It allows them to increase the sheer velocity at which they can bring new pricing models and new products to the market.
But here's the thing. Upgrading your servers to contemporary platforms is essentially just playing catch-up. It's getting the house in order so you can adequately compete in the present day. But what Erie is doing next, and this brings us to the final, and frankly, the most mind-bending part of this entire earnings call, is looking far past the present and directly toward the future.
We need to talk about their enterprise AI integration.
Yes. This was undeniably the most surprising revelation of the call. I mean, you do not expect a century-old, structurally conservative mutual insurance company to be at the bleeding edge of artificial intelligence.
No, you really don't.
But they aren't just quietly tinkering with AI in some isolated IT lab.
Yeah.
They have achieved full enterprise-wide AI deployment.
Which is a massive distinction. The CEO showed that they have completely moved past the quote-unquote experimentation phase. They have rolled out highly secure, scaled tools, specifically citing the deployment of ChatGPT Enterprise.
Across their entire employee population. That is a staggering operational leap. They aren't gatekeeping the AI, restricting it to just a handful of data scientists. They are democratizing it, putting it directly into the hands of the everyday workforce.
Right, but what does that actually look like in the trenches?
Well, the CEO didn't just drop the buzzword and move on. He gave a very specific real-world application of how they're using ChatGPT Enterprise. It absolutely blew my mind. He talked about using it for subrogation.
Subrogation, that's a heavy word.
It is. Now, for the listener, subrogation is one of those incredibly dense legal concepts that sounds intimidating, but if you've ever been in a car crash that wasn't your fault, you've actually experienced it firsthand.
Okay, set the scene.
Let's say you're sitting at a red light and someone rear-ends you. You call Erie. Erie doesn't wait for the legal system to figure out who is at fault. They just write you a check immediately so you can fix your bumper, rent a car, and get on with your life.
Right, because that's what you pay them for.
Exactly. But Erie isn't just going to eat that loss. Behind the scenes, Erie's lawyers and adjusters quietly go hunt down the at-fault driver's insurance company to demand that money back. That legally complex hunt for reimbursement is called subrogation.
Perfect explanation. And to understand why AI is an absolute superpower in subrogation, you have to understand the sheer crushing volume of unstructured data involved in the process.
What do you mean by unstructured data?
To prove the other driver was at fault and demand a reimbursement, Erie's paralegals and claims adjusters can't just send a polite email. They have to build an airtight legal case.
Right.
That requires reading through thousands of pages of deeply unstructured documents. We're talking blurry PDFs of police reports, handwritten witness statements, scratched on notepad paper.
Oh, man.
Highly dense medical bills with thousands of individual line items, auto repair invoices detailing hours of mechanical labor, and endless messy email chains between auto shops and adjusters.
That sounds awful.
It is. Historically, a human being had to sit at a desk, read every single page, highlight the relevant facts, and manually type up a summary to prove liability. It is grueling, mind-numbing work.
Enter ChatGPT.
Exactly. By deploying secure large language models like ChatGPT Enterprise, the game completely changes. The AI can ingest a 400-page file of unstructured, messy documents and synthesize the facts almost instantly.
Wow.
It can extract the key dates of the accident, cross-reference the mechanic's repair timeline with the police report's damage assessment, and instantly draft a cohesive liability argument.
So it does all the grueling manual data extraction work.
Yes, quote, more quickly and consistently, as the CEO noted. It accelerates the entire life cycle of getting Erie's money back, which directly bolsters the bottom line.
And critically, because they are using the enterprise version of these tools, they are doing it securely.
That's a huge point.
They aren't typing sensitive medical records into the public version of ChatGPT to train an open model. They have a ring-fenced, private environment that complies with the massive data privacy regulations of the insurance industry.
It's an incredible application of the technology.
It really is. But what I found truly compelling about this section of the transcript wasn't just the raw technological capability. It was the philosophical stance the leadership took regarding their workforce.
Right.
We're living in an era where massive chunks of the corporate workforce are terrified that AI is coming to eliminate their jobs and replace them with algorithms.
Oh, absolutely. It's a huge fear.
But CEO Tim Nekastro used very specific, very deliberate language to counter that fear. He told his investors, point blank, this isn't about replacing people, it's about helping our employees do their best work.
Yeah.
From an expert perspective, looking at the macro trends in the financial sector, how do you view this philosophical approach? Is it just corporate lip service, or is there a strategic moat here?
It is a profoundly strategic stance, and it cuts to the absolute core of what insurance actually is.
Tell me more about that.
Insurance, at its foundational level, is not a tech product. It is a business built entirely on assessing human risk and providing human support during moments of extreme crisis.
Right.
When a family's house burns to the ground or a teenager is involved in a severe traumatic auto accident, they are in a state of shock. They do not want to be consoled by a highly efficient chatbot.
No.
They don't want an algorithm to tell them their claim is processing. They need empathy. They need the nuanced judgment and the stabilizing care of an experienced human adjuster to walk them through the worst day of their lives.
That makes total sense.
The judgment, the empathy, and the century of accumulative human experience remain Erie's ultimate, unreplicable competitive advantage. What AI does is handle the massive, invisible backlog of administrative friction.
It reads the 40-page police reports, the adjuster doesn't have to.
Exactly. It accelerates the data extraction and drastically reduces the risk of a tired paralegal missing a critical detail buried on page 72 of a medical file. But the AI doesn't make the final call. The AI doesn't deliver the news to the family.
Right.
Erie is deliberately positioning this technology to strengthen the human touch by removing the robotic, soul-crushing data entry from the humans' plates, allowing them to focus entirely on the complex, empathetic work that only a human being can do.
They're using robots to allow their humans to be more human.
That's a great way to put it.
It is a fascinating juxtaposition. And, it really brings us to a perfect synthesis of this entire journey we've taken through the transcript today.
We really covered a lot of ground.
We did. We started by looking at a legacy company honoring its 1925 founders by elevating a multi-generational bloodline to steer the board. We saw how that steady hand at the wheel allowed them to survive a catastrophic, historically devastating weather year in 2025. We watched them wrestle with the painful mathematical tug-of-war between raising rates to achieve that 99.4% combined ratio and the subsequent 12% loss in customer retention.
Yep.
And ultimately, we saw them pivot to combat that growth problem, tearing out their legacy plumbing to build modernized quoting platforms and deploying enterprise-scale AI to secure their competitive future. It is an incredibly dense, layered narrative of corporate adaptation.
And if we step back and connect all of these seemingly disparate pieces to the broader economic picture, it leaves us with a deeply provocative thought about the nature of innovation itself.
Oh, I like the sound of that. Lay it on us.
In the modern business press, we often default to thinking of century-old legacy companies as slow-moving dinosaurs, right? Laid down by tradition, just waiting to be disrupted and driven to extinction by sleek, agile Silicon Valley tech startups.
Yeah, that's definitely the prevailing narrative.
But looking at how Erie Indemnity operated here flips that script entirely. They used the crucible of a devastating 2025 weather crisis to force a massive evolution.
They did.
They pushed necessary rate adequacy, they standardized complex platforms across a fragmented regulatory landscape, and they seamlessly integrated large language models into core legal workflows like subrogation without fracturing their culture.
Which is incredibly hard to do.
So it raises a vital question for the future of the economy. Is the true, unassailable advantage in the modern era not having the absolute newest, flashiest technology, but rather having a century of deep human relationships, community trust, and 100 years of proprietary granular data to point that new technology at?
Wow.
A startup might be able to code the algorithms, but Erie has 100 years of history to feed them.
The algorithm is completely useless without the trust and the data to back it up. That is a brilliant framework to view the future of legacy business through.
It really makes you rethink who holds the cards.
Absolutely. Well, to you, our listener, thank you so much for joining us on this deep dive. We hope you walk away with a total indie perspective on how century-old companies are quietly navigating the bleeding edge of the future, one dense, jargon-filled earnings call at a time. Keep looking past the numbers, keep questioning the narrative. Until next time, keep diving deep.